Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the headlines tonight. Stock markets plunge on weak global cues and concerns over rising inflation and weak corporate results. Sensex down 1,172 points. Nifty slips 302. IT stocks lead the fall. Wholesale price inflation jumps to more than 14.5% in March. Petrol, diesel, vegetables, oilseeds lead the price rise. First real indications of the impact of the war in Ukraine. India's largest bank, SBI, increases MCLR by 10 basis points. Home and other loans to be more expensive. Higher return on fixed deposits. Kotak Mahindra Bank also raises its rates. Horrific visuals of a raging fire in a dealership of Okinawa e-scooters, even as the company announced the first electric vehicle recall in the country. And a special report on shadowy underground crypto exchanges helping investors save on taxes in India. It was a sea of red on Dalal Street. Bears were on a rampage this manic Monday. Sensex nosediving over 1,172 points, slipping below 57,200, while the Nifty cracked over 300 points to post its worst day in over a month. Dismal March quarter earnings by HDFC Bank and Infosys, coupled with the fall in stock markets across the globe, rising inflation, a surge in crude oil prices weighing on investor confidence. China GDP figures, which were below expectations, also hurt sentiment. Sectorally, the IT packs suffered huge gashes. Nifty IT declined nearly 5%. Nifty PSU Bank and Financial Services declined over 2% each. Nifty Bank and Realty were also among the laggards. Infosys, HDFC Bank, HDFC contributed more than 200 points to the fall in the Nifty. The market cap of these companies suffered a major hit. The massive sell-off left Dalal Street investors poorer by over 2 lakh crore rupees. The Nifty IT index, the biggest loser today, declining 5% in trade. The sector traded at its lowest level since February 24th. Post those dismal numbers by Infosys this last quarter, that particular stock was the top laggard, declining over 7%. Weak numbers posted by industry bellwether Infosys led to a massive fall across the board in IT shares. The valuations for IT companies remain stretched, however. With high attrition rate, new hires coming in at a significant premium, and increasing supply costs, margins have taken a beating. The market is also worried about the cut in IT spending by industries due to geopolitical and macro issues. Bucking the trend, Tata Steel was up nearly 2% in trade today. The shares rose as the company announced it would consider a proposal to split the stock and also recommend a dividend. The Tata Steel stock ended at 1,340 rupees today. A stock split is generally undertaken to make the stock more affordable to retail investors and increase liquidity. The board is expected to decide on the issue on the 3rd of May. Joining me today, a very special guest, A. Balasubramaniam. He's MD and CEO of Aditya Birla Sun Life AMC, as well as chairman of AMFI. And Bala has been, someone who we've been speaking to for many, many years, and look forward to having him today here on Business Today. Bala, first, let's get your all-important take on the markets. We saw a nosedive today. Is that just a reaction coming into the latest set of earnings? Where are we when we take a look at the overall trajectory? Because there's a lot of uncertainty and nervousness about whether or not a drastic fall is coming.
I think, first of all, thanks, Abha, for having me part of the show today. Clearly, from a market point of view, I think we are just coming after the recent uncertainty that got created thanks to the Russia and Ukraine war, and which has led to the complete rise in the commodity prices globally. They also put a question mark in terms of how the growth is going to come back by way of global spending, which was likely to be the driver of the market earlier. and with this change in the dynamic, the geopolitical risk that has come, definitely I think the growth expectations have got moderated. But having seen inflation rising across the globe and Fed now having taken the first step of rising interest rates, I think now is becoming a phenomenon globally of interest rate cycle to begin. But that being the case, definitely from a market point of view, is not something I think you would get to see only the growth and the earnings growth, and then the market will be driven as a result of that. And this uncertainty definitely is now playing a role in the equity market. Having seen a significant rise in the last few years, last 2 years, we saw a significant rise in the equity market. Therefore, I would say the correction is actually the function of that valuation getting corrected, and the earning expectations are getting moderated, and the interest rate hike is also now getting confirmed that yes, interest rate is going to now stay on the up cycle. And these are some of the things I think is still playing its role on the market in terms of driving the volatility. But having seen that, market always goes through some ups and downs, having seen a significant rise. This is my own belief is part and parcel of the broad market trajectory.
So, Bala, how well do you feel domestic factors are placed at the moment? Because there were also some fears on growth in terms of what we took away from the RBI's latest commentary. So earlier, while the narrative was that even if globally things look rocky, domestically we're continuing to see robust interest in equities and growth. If growth starts to look rocky back home, what happens next?
So I think from India point of view, we can probably say to some extent, we stand out a little different from the global economy. There is no question because of one, we're also a consumer of commodities. We're also producers of commodities. And second is the efforts that the government has been putting in terms of improving the overall GST collections and tax collections have been on the uptake. The rural economy continues to do very well. And then the government spending in terms of replacing the private sector capex, which has been missing for quite some time. The government of India has been the single largest spender, both in building the infrastructure across the country, jointly with the state government. Therefore, that is actually driving the overall the expectation of the growth. That's if you look at, I think most of the consumption of various produce in the country has been on track, except on automobiles. I would say there is a marginal dip. But at the same time, from a domestic point of view, the rural economy, I think probably would be the major driver as next round of growth, and that not got anywhere impacted from the growth expectation to moderated quite substantially. Therefore, from India, I think probably would become the biggest beneficiary. The moment we see some progress happens on the positive side on the Ukraine and Russia war, and therefore actually lead to a significant drop in the prices of commodities. And combined with that, what we are seeing in China has been going through a tough time. Even the pandemic itself, they are still not come out of it, and then come back on growth path is going to take some time. That has been the case, and India would emerge as a strong winner in the whole process after say 2-3 months. I think that 1 or 2 months, I think, are directly linked to the global market sentiment. I think our equity market continues to remain volatile. But I think as we progress clearly, I think India could stand out differently from the rest of the world.
Interesting. So you're saying we're well placed in the overall scheme of things. In terms of flows, Bala, I have to just touch upon that before I get into specific pockets of the market and where you see opportunity. In terms of flows, what do you feel is going to be, or where do you feel we're going to see strongest momentum? Are we still seeing the China Plus advantage coming in with money moving into India with the rate hike, the anticipated rate hike in the US? How's that going to impact things?
Yeah, I think I'll put it in two parts. Yeah. I think the flows in the equity market from domestic investors will continue to remain robust.
Okay.
For one simple reason that there is no much of credit demand that is coming from the banking system point of view. I think RBI continues to maintain reasonably good liquidity situation in the system, in the whole banking systems. At the same time, the absence of credit offtake a big time happening. The banks continue to remain somewhat the believer of keeping the low interest rate, especially on deposit offering. Therefore, from the investors' point of view, I think there are not much alternatives left. Therefore, their interest towards equity market will continue to remain, given the fact they are coming for the long term. As far as the overseas market concerned, I think definitely the rise in interest rates globally, especially in the US, 10-year bond yields touching 2.89, and earlier about 6.5 times number of times in which the interest rate hike was supposed to come. I think as latest as last week, they have now increased 8.5 times the number of hikes could come. And potentially, assuming scenario in 2024, we expect US 10-year bond yields to be close to about 4%. Then naturally, I think the flows will not come to the rest of the market. I think flows will stay within the US, and probably a time will come the bond yields become more attractive than actually even the equity market in US. Therefore, some element of shift will happen. Therefore, expecting global flows to come to India at this point of time may not be fair.
Right.
Having said that, as I mentioned, the rationale behind money coming into India, before I just mentioned about that India probably will stand out completely different from the rest of the global economy. And that is the time I think India will start seeing some kind of fresh flows of funds in the second half of this financial year. Given the fact that India will probably be a bit insulated from the rest of the global market, and the currency market in India, I think it behaves much more stable rather compared to most other economies. And forex reserve that India is carrying is also pretty good. And therefore, on a holistic basis, India is managing the whole situation quite nicely. Therefore, the confidence of global investors coming to India, second half of this year, I think would be different from what you are seeing in the first half.
Bala, you said that pockets like IT, banking will continue to be mainstays of one's portfolio. But where do you see the potential for multifold returns? You talked about the rural economy, of course. What are some of the perhaps plays based on that, or other ancillary plays that you feel could really be the big surprise going forward?
I think more than the surprise, of course, surprise comes in one or two sectors. It doesn't come in all the sectors.
Sure.
And as we normally know historically that we have seen. But I think when I say the integral part of the economy, whether it is banking sector is considered as a proxy within an economy, I think the structurally ITS sectors falling into the longer term growth story. The same way we look at FMCG companies, and given the fact they cater to the growing needs of the consumer demand in the country, especially on the consumption story, there are many companies falls in that category. There are many small companies who actually bring in innovation and bring in new way of doing business, reaching out to the customers in a much faster pace at lower cost and so on and so forth. There are many companies that actually does a lot of innovation, and that's why I think the companies actually focus on this innovation, focus on consumer centricity, and probably would become one of the large winners. Very difficult to actually attach this to any specific sectors, given the fact that this innovation can happen in any sectors. But having said that, I think the traditional businesses, as long as they're able to modulate the business completely different to the new world, including auto space, auto ancillaries, especially in foraying into the EVs, and yet become a more profitable and also become a scale player. There are many companies and existing companies who have a longer term track record. They're all actually moving into the direction. Therefore, all such companies could potentially become, I would say, the multi-bagger as we move forward.
Let's take a very quick break. Back with more on the other side. Welcome back. Wholesale price inflation has risen to a record high of 14.55% in March. WPI has gone up by a whopping 144 basis points in March on a year-on-year basis. Rising crude oil prices and increase in the price of basic metals has led to this surge. So how worrisome is the situation and what does it imply? Here's a report.
The Wholesale Price Index, which captures the average change in prices of goods at the wholesale level, has soared to 14.55% year-on-year. With this, the WPI completes 1 year in double-digit territory. Rising over 4% rate of inflation in March is primarily due to rise in prices of crude petroleum and natural gas, mineral oils, basic metals, owing to disruption in global supply chains caused by the Russia-Ukraine conflict. So how does wholesale inflation impact you? Going forward, the recent increase in petrol, diesel and gas fuel prices will further fuel the surge. Input price pressures and supply-side shortages will push up prices at the consumer level. The supply disruptions will also lead to high transportation and logistics costs, leading to a further price rise. Take a look at how wholesale price inflation has already wreaked havoc in the past 1 year. With crude oil prices on the boil, petrol and diesel prices have seen a whopping 50% increase in a year. Prices of basic metals have surged 26% since last year. Oil seeds too cost 22% more. Vegetables now cost 20% more than the previous year. The Reserve Bank of India has taken note of rising inflation and may be forced to act on policy tightening after March inflation. The ball is in the Reserve Bank's court now that its biggest enemy, inflation, is back with its full might.
A combination of high international commodity prices and elevated logistic disruptions could aggravate input costs across agriculture, manufacturing, and the services sectors. Their pass-through to retail prices, therefore, warrants continuous monitoring and proactive supply management.
If the RBI does increase the interest rates, your home loans are likely to get more expensive even as inflation eats into your savings. Bureau Report, Business Today Television.
The era of low home loan, auto loan rates could all be over. The largest bank in India, State Bank, has raised its lending rates by 10 basis points. With this, all SBI loans, be it home, auto or personal, are expected to get costlier. Kotak Mahindra Bank and Axis Bank have also raised their lending rates. Other banks are expected to follow suit. Visuals which have shocked the country of an e-scooter dealership in a Chennai suburb going up in flames. According to reports, the battery of an e-scooter at the Okinawa showroom in Porur caught fire and the blaze quickly spread across the entire showroom, completely burning 5 new electric vehicles. 12 other e-scooters which had come to the attached workshop for servicing were also damaged. Reports say a customer had left his e-bike on charging when it caught fire. Police have registered a case and started a probe. If you remember, Okinawa had only recently announced the country's first electric vehicle recall. The company, meanwhile, in a statement to Business Today TV, has blamed a short circuit for the fire at its showroom. According to Okinawa Auto Tech, its dealer has also confirmed the same. For more information on the issue, we have with us Chetan Bhutani, our associate editor. Chetan, naturally some fears when one sees an incident of this kind, but the management does seem to be implying that this was due to a short circuit at that particular showroom.
Well, that's it, Abha. Okinawa has been at the forefront of dealing with the fire incident. In fact, on April 16th, they issued a voluntary recall of about over 3,000 electric scooters. Now, in a statement to Business Today TV, I'll quote the statement, and it mentions that please note that the fire was due to an electric short circuit in the panel wiring in the building, and the dealership has also confirmed the same. Unquote. So clearly, it's the fault of the building, as what Okinawa management is saying in a statement to Business Today TV. Well, in the due course of time, the investigation would be done by the officials and, of course, the authorities in the times to come. Yes, but the extent of fire of electric scooters is definitely a worrying cause, as you mentioned, Abha. In times to come, we'll have to wait and watch what government would announce certain measures. Remember, in last week, Ministry of Road Transport and Highway Secretary Girdhar Ramane told us that government would be soon issuing a variety of steps to control the situation. So in times to come, yes, we'll have to wait and watch what the government does. Meanwhile, the auto companies, especially Okinawa, is doing all they can to control such incidents.
Thanks for joining us with that, Chetan. Let's take a look at what else is making news in the corporate world. The Enforcement Directorate has provisionally attached assets worth 757.7 crore rupees belonging to multi-level marketing company Amway India. The company is accused of running a multi-level marketing scam. One-stop restaurant management platform Urban Piper has raised $24 million in Series B, led by existing investors Sequoia and Tiger Global. It's also onboarded restaurant aggregator and online food delivery majors Zomato and Swiggy as new investors. Gurugram-headquartered budget airline SpiceJet has announced the launch of new flights on domestic and international routes from April 26th. They include additional frequencies and non-stop flights and a new flight on the Delhi-Porbandar sector. In a statement, the company said it's deploying its Boeing 737 and Q400 aircraft fleet on these new routes. Real estate company Indiabulls Real Estate said that it successfully completed a capital raise of $114 million or over 871 crore rupees through qualified institutional placement. The QIP was completed at 101.1 rupees per equity. India's move to crack down on all kinds of crypto trade has forced investors to adopt alternate platforms. These platforms, known as decentralized crypto exchanges, are out of the government purview as they are not located in India physically and proliferate online, where they enable users to bypass the 30% income tax and the 1% TDS on crypto. Here's more on that story.
Industry sources say India's high taxes on crypto has led to investors gravitating towards decentralized crypto exchanges in a bid to avoid paying the heavy tax on their crypto trades. Some of the popular decentralized exchanges are Uniswap and PancakeSwap. Importantly, these exchanges are not subject to any government regulation. There's no KYC involved. All you need to do is link your crypto wallet to one of these exchanges and start trading. There are no brokers involved and all trading is peer-to-peer. That is between people holding cryptocurrencies.
The account books of these institutes, of these DeFi protocols are distributed. It means that the government does not control that node, right? So these are distributed. So you simply need to go on these type of platforms and start engaging it. Theoretically, it can't be taxed because government would not have access to that node, right? And they can't instruct a DeFi institute to give them their accounts book or change the laws.
Even the wallets like MetaMask, which are used for these trades, do not need a KYC verification. This keeps all trades under government radar. Curiously, the crypto ecosystem has expanded to such an extent that investors do not need to convert their crypto gains into rupees again. Investors have the option of converting their highly volatile cryptos into more sustainable cryptocurrencies like the US dollar Tether or USDT. The Tether is linked to the value of US dollar and is among the most stable cryptos in the world. The USDT is accepted by many stores and restaurants around the world, making it a convenient cryptocurrency of use.
Your contention might be that it can fall also. So that volatility is there. To avoid that volatility, you just convert it into USDT and store it as an FD in a crypto bank, right? So that's your option one. But if you still insist that you have to get out of the crypto system, I have to convert it into fiat currency, I would not like to say it publicly, right? But there are other options where you can, sort of use other P2P, peer-to-peer based transaction systems across different parts of the world to get out into a different fiat currency altogether.
More risky and illegal is to deposit these USDT in tax havens like Cayman Islands, Bahamas and others where financial institutions not only accept them but convert them into currencies of your choice and deposit them in their accounts. While crypto investors try and keep their tax liability low, the taxmen will not be far behind in trying to plug the loophole. With Akanksha Chaturvedi, Bureau Report, Business Today TV.
That's all we could pack into the show tonight. Thanks so much for watching.